Silver was trading around $93.80 per troy ounce as the week opened. And then the market did what it always does when liquidity gets thin. It tried to rip the floor out from under everyone at once. Data box. Within hours, we saw the kind of move that makes your stomach drop. A hard flush that pushed silver down into the mid-80s, with one widely shared quote putting it around $85.66 per ounce before the selling intensified even further, and Reuters later marking silver down to about $83.63 per ounce. I'm today's market screener UK. That's a brutal swing for a normal market, and it's exactly why today's title matters. When you get a violent drop like that and price refuses to stay down, it's not just volatility, it's the market testing who's real and who's forced. At the same time, gold is still acting like the stress gauge. We came into this week with gold ripping above $5,300, with continuous futures trading around $5,346.20 per ounce on Monday. Barons. And even after the pullback, on Reuters still had spot gold around $5,252.05 per ounce on Tuesday. Still historically elevated, still telling you uncertainty hasn't magically vanished. Reuters. So here's the moment of truth. When silver gets hit like that, the flush is designed to do one thing: force decisions. It hunts stop losses, triggers margin stress, and scares people into selling right when the market is most thin. But the rebound, whether it's fast, violent, and relentless, or weak and easily sold, tells you what the flush actually was. Was it real demand stepping in under the market, or was it just mechanical snapback from short covering and thin order books? Before we go deeper, do me a quick favor. Hit like, subscribe, and comment one word right now. Breakout. If you think this failed flush is a bullish tell, or fake out if you think it's bait before the next slam. I want you on record before the data answers it. And I'm not going to do what most channels do, scream headlines and call it analysis. We're going to keep this tight and verifiable. In this live update, I'm going to walk you through the exact chain. What just happened, why it happens in markets like silver, and the clean triggers that separate a real move from a trap. So you're not reacting to adrenaline, you're tracking structure. One quick reminder, this video is educational and for entertainment only, not financial advice. Don't trade off hype, trade off rules, position sizing, and confirmation. Now stay with me, because in the next section, I'm going to break this down into the three forces driving the chaos, and then I'll show you the single tell most people miss while they're staring at the price. Let's rewind and slow this down, because when silver moves like this, most people remember the adrenaline and miss the structure that actually tells you what's happening. As this week opened, one widely published snapshot had silver at $94.26 per troy ounce at 8:45 a.m. Eastern Time on Monday, March 2nd, while gold was $5,404.16 per ounce at that same time. Fortune. That's your starting frame. Metals elevated, attention high, and the tape already acting jumpy. Then the air pocket hit. By Tuesday, Reuters had spot silver down 6.5% on the session to $83.63 per ounce, while spot gold was still extremely elevated at $5,252.05 per ounce. Shy Reuters. That's not a tiny wiggle. That's a $10.63 move in silver from that Monday morning quote to Tuesday's Reuters quote in roughly a day. Fortune. Now, here's why the flush part matters more than the headline. A fast drop like that usually isn't one clean story. It's a chain reaction. Liquidity thins out, the first wave of selling pushes price into a shallow order book, stops start triggering, and then forced selling piles on top, especially in a market like silver that's notorious for violent whipsaws. And silver is exactly the kind of market where a move can look irrational if you're only watching price, but looks totally logical if you're watching what thin liquidity does under stress. The rebound is the message. A flush that doesn't stay down is the market testing whether there's real demand underneath, or whether the bounce is just mechanical snapback from shorts covering and the book refilling. That's why I asked you to comment breakout or fake out in the opener, because the next 24 to 48 hours will reveal whether buyers are actually defending a zone or whether this was just a reset before the next slam. And for anyone trading futures, this is where people get blindsided. A standard COMEX silver futures contract is 5,000 troy ounces, so a $1 move in silver is $5,000 per contract. CME Group. Even the minimum tick is 5 cents per ounce, which is $25. And in a tape like this, you can chew through ticks like they're nothing. CME Group. This is why I keep saying, don't let volatility choose your risk for you. One more thing that keeps this from being just silver. Gold staying this high means the stress backdrop hasn't gone away. On Monday, Barron's noted continuous gold futures around $5,346.20 as the Middle East conflict boosted safe haven demand. Barron's. And even with Tuesday's pullback, we're still talking about gold above $5,200, which is not a calm market regime. Reuters. So here's the open loop you need to hold on to. The same price action can be caused by totally different engines: macro pressure, war risk premium, or market structure. In the next part, I'm going to separate those three forces cleanly, and then show you the single tell that usually exposes whether this bounce has real fuel or whether it's bait. So let's separate the three engines cleanly, because this is where most people get tricked. They blame the wrong cause, take the wrong trade, and then swear the market is rigged when it was really just structure doing what structure does. Engine 1 is macro pressure, rates, the US dollar, and the market's appetite for risk. When the dollar jumps or rate expectations firm up, and their precious metals can get hit because they don't yield anything, and liquidity can evaporate fast in silver. That's exactly the kind of backdrop Reuters described today. Gold was down about 1.4% to $5,252.05 per troy ounce. And the narrative wasn't safe haven disappears. It was the dollar strengthened and rate expectations rose. In that same window, silver was down 6.5% to $83.63 per ounce, which tells you silver is still the volatility amplifier in this tape, offered by Reuters. Engine 2 is geopolitical risk premium. This matters because it can keep gold supported even when other forces push prices around. Reuters reported gold had been rising on fears of a prolonged Middle East conflict, with spot gold around $5,297.31 per ounce at one point, and US gold futures ending around $5,311.60 in that earlier session. That's the stress floor dynamic. Even when price dips, the market keeps paying for uncertainty. Auction Reuters. But here's the part that makes silver feel possessed. Engine 3 is market structure. This is the plumbing: thin order books, stop clusters, options hedging flows, forced liquidations, and short covering. It's not a conspiracy, it's mechanics. When liquidity thins out, a single wave can punch through multiple levels and create that air pocket flush you just lived through. And when it snaps back, that bounce can be real buying, or it can be a mechanical rebound because the market briefly ran out of sellers and shorts had to cover into a thin book. This is why I keep pushing you to think in triggers, not feelings. A failed flush can be bullish, but only if the market behaves like it's being defended. Real demand tends to do three things. It absorbs repeated selling in the same area, it doesn't let price collapse on the next hit, and it forces sellers to work harder for every lower low. A mechanical bounce, on the other hand, often looks strong for a moment, then gets rejected the first time it meets a real wall. Because it wasn't demand, it was recoil. And if you're trading this with leverage, you have to respect the math. A standard COMEX silver futures contract is 5,000 troy ounces, quoted in US dollars per ounce, and the outright minimum tick is 5 cents per ounce, which equals $25 per tick. That's why silver doesn't just move your chart, it moves your account. Kitco CME Group. So here's the emotional truth. The flush is designed to make you panic sell, and the rebound is designed to make you FOMO buy. That's the squeeze. If you want to beat it, you need a simple rule. You don't fall in love with a bounce until the market proves it can hold. Drop your vote again, breakout or fake out, because the next 24 to 48 hours will answer it. And if you want these rapid, data-first updates the moment the next violent candle prints, hit subscribe and comment 5-minute update so I know to keep doing them. Now we're ready for the proof segment, 3 checkable signals that will tell us whether this rebound has real fuel or whether it's just the market resetting before the next slam. Now we get to the part where opinions stop mattering because the market already printed the only thing that counts, the stress test. On Tuesday, Reuters had spot silver down 6.5% to $83.63 per troy ounce. While spot gold was still way up the curve at $5,252.05 per ounce, even as the stronger US dollar and rate expectations pulled prices back. Reuters. That right there is the signature we're dealing with. Gold still elevated, silver whipping violently. This is exactly the kind of environment where a flush can either become a launchpad or a trapdoor. So here are the 3 proof signals, simple, checkable, and designed to keep you from becoming liquidity for someone else. First, audit the flush candle like a crime scene, not like a horoscope. Don't just stare at the price. Look at how the move behaved. When you see a fast air pocket drop and then a sharp snapback, that's often thin liquidity getting ripped. Reuters already confirmed we're in a high volatility tape today, not a slow grind. Reuters. If you're watching live charts, your job is to see whether the rebound produces stability, higher lows, tighter pullbacks, and follow through, rather than a one-and-done bounce that immediately gets sold the moment sellers reload. Second, check whether the real world is relaxing or staying tight. Spot can flush faster than physical reality can reset, and that mismatch is one of the cleanest tells in metals. For example, one dealer trading sheet, timestamped early March 3rd, showed gold around $5,305.22 and silver around $85.66 at that moment, numbers that echo the same mid-$80 silver on $5,300-ish gold regime we're discussing. Scoins.com. I'm not telling you to trust any single dealer, quote, use it as a lens. If silver nukes, but frictions, premiums/availability/lead times don't suddenly normalize, that's a clue. The flush was more paper-driven than physical, suddenly got easy. If physical conditions loosen quickly and consistently across sources, that leans more toward mechanical whipsaw than structural tightness. Third, respect the leverage math, because this is where people get forced into bad decisions. A standard COMEX silver futures contract is 5,000 troy ounces, quoted in US dollars and cents per ounce, and the outright minimum tick is 5 cents per ounce equals $25. CME Group. That means even a small $1 move is $5,000 per contract. Ocean and the kind of swing we just saw into the low 80s can be an account event if you're oversized. Reuters. This is why I keep hammering it. Don't let volatility choose your position size for you. So here's what you do with this, right now. You stop arguing narratives and you start tracking behavior. If the rebound is real demand, it will defend zones repeatedly and refuse to collapse on the next hit. If it's mechanical, will look impressive for a moment, then fail at the first real wall and roll over fast. Comment breakout if you think the market is defending underneath this flush, or fake out if you think it's a recoil before the next slam. And if you want these fast, data-first live updates the moment another violent candle prints, hit subscribe and comment 5-minute update, because in a tape like this, hesitation is expensive. Quick reminder, educational and entertainment only, not financial advice. Now that you've got the 3 proof signals in your head, here's the scenario map, because the market is basically standing in front of you right now with a fork in the road, and it's daring you to pick a direction based on emotion instead of triggers. Gold is still telling you the system is stressed. Even after today's pullback, spot gold was still around $5,303 per troy ounce, with US futures near $5,317. Reuters. That's not a calm, normal tape. Actually, that's a tape where fear is still being priced in. And that matters, because when fear stays bid, silver doesn't politely trend. It whipsaws, flushes, and then tests whether buyers are real. So scenario 1 is the breakout continuation, the path where the failed flush turns into a launchpad. The trigger for this isn't a feeling, it's behavior. You want to see silver reclaim key levels and stay there under pressure. We've recently seen silver trade in the low to mid 90s per ounce, with reports around $93.67 during this run-up. The Economic Times. In a breakout continuation, the market defends that zone after every dip. Volume comes in on up moves and pullbacks become shallow and short. Gold staying above $5,300 plus supports that narrative, because it tells you safe haven demand isn't fading. Reuters. If that's the path we're on, the psychological magnet becomes obvious. $100 per ounce for silver. Not because it's magic, because it's where attention, options positioning, and retail psychology often pile up all at once. Scenario 2 is the fake out, the path where the rebound is mostly mechanical and runs straight into a wall. Here, the tell is simple. Price pops, excitement returns, and then the market can't hold gains when real selling shows up again. That can happen fast in a thin tape. Some live spot feeds had silver down in the mid-80s per ounce early March 3rd. For example, $85.73 per ounce at one timestamp, showing how violent the swings are in this window. OlkajamBullion.com. If silver keeps printing lower highs and fails to regain the prior decision zone in the low 90s, that's when the rebound starts looking like a reset, not a launch. In that scenario, gold can stay strong while silver underperforms, because silver is the metal that gets hit hardest when leverage and liquidity collide. Reuters even had silver down about 4.2% in the latest session, alongside broader weakness in other metals. Reuters. That's the kind of tape where chasing candles becomes a donation. Scenario 3 is the one that traps the most people. Range and volatility compression. The market stops trending, starts chopping, and both bulls and bears get punished for overreacting. Gold can stay elevated, oil can stay jumpy, and silver can still go nowhere for a stretch, right before it moves the hardest. Some with Middle East risk pushing energy higher. Brent was reported around $79.50 a barrel in the broader risk-off move. Markets can get stuck in headline mode, where price coils and then detonates. Reuters. If we're in this scenario, your edge is patience. You wait for a clear break and confirmation, instead of trying to predict the break. So here's what I want from you right now. Comment breakout if you think silver reclaims and holds the low 90s zone and starts hunting $100. Or comment fake out if you think this bounce fades and the next flush is still ahead. And if you want me to keep doing these fast live maps the moment the next violent candle hits, subscribe. Because in a tape like this, the market doesn't give second chances. And one more time, this is educational and entertainment only, not financial advice. Your job isn't to be right on a headline, it's to follow triggers, control risk, and avoid becoming liquidity for someone else. No matter which path we're in from that scenario map, breakout, fake out, or a brutal sideways coil, the way you survive a tape like this is having one rule. You don't let volatility decide your position size for you. Because look at what we're dealing with right now. Reuters had gold around $5,252.05 per troy ounce on Tuesday, and silver down to about $83.63 per ounce in the same window. Reuters. That's after silver had already been trading up around the low 90s recently, which tells you how violently this market can whip from euphoria to punishment in hours. Reuters. So here's the playbook, and I'm going to speak to 3 types of viewers because the biggest mistake is copying someone else's style. If you're a long-term holder, your edge is time, not speed. Your job is to avoid leverage and avoid panic. In a market where a single flush can erase multiple days of gains, the win condition is staying solvent, staying calm, and not letting one candle force you into a decision you'll regret. If the reason you're here is wealth protection, then your focus is ounces and risk control, not calling the top or calling the bottom. If you're a trader, then you need to respect what a 9% flush actually means in dollars. On a standard COMEX silver futures contract, one contract is 5,000 troy ounces, and the minimum tick is 5 cents per ounce, which is $25 per tick. CME Group. Now do the math. A 9% move from $93 is about $8.37. On 5,000 ounces, that's roughly $41,850 per contract in price exposure. That's why people get margin called in markets like this. Not because they were wrong, but because they were oversized, and margins can tighten exactly when volatility spikes. Reuters reported CME raising margins again, with COMEX 5,000 silver futures going from 15% to 18% for certain account classifications, effective after February 6, 2026. Reuters. In plain English, the market can demand more cash from you at the worst possible time. If you're new, the cleanest way to learn without getting wrecked is to shrink the blast radius. CME's micro silver contract is 1,000 troy ounces, also quoted in dollars per ounce. CME Group. Same market, smaller size, so you can practice discipline without one wick turning into a financial emergency. And here's the part that beats the crowd. Stop trying to predict the next candle and start tracking triggers. If we're in the breakout scenario, you want to see the market reclaim levels and hold them under pressure. If we're in the fake out, you'll see pops that get sold and fail to hold. If we're coiling, you'll see chop that punishes both sides until the real break arrives. Your job is not to guess which one should happen. It's to size so that you can follow the evidence when it does. Drop your vote right now. Breakout or fake out. And if you want me to keep doing fast live updates when silver prints another violent candle, subscribe and comment 5-minute update, because in markets like this, the next move doesn't wait for anyone. And quick reminder, this is educational and entertainment only, not financial advice. So here's how we close this out without guessing. Because the market is doing what it always does in high stress conditions, and it tries to drag you into a decision before you have clarity. Yesterday, we were talking about silver living around that $93 to $94 neighborhood. One widely tracked snapshot had silver at $93.80 per troy ounce on the morning of Monday, March 2nd. Databox. Then today, the market printed the kind of move that feels like a gut punch. Reuters had spot silver at $85.66 per ounce on Tuesday, March 3rd, while gold was still sitting above $5,300, specifically around $5,303.09 per ounce at the time of that report. Reuters. That's the story behind the title right there. From $93.80 to $85.66 is about an 8.7% drop. Basically, the 9% flush everyone feels in their chest when it hits. Databox. And the reason it matters is not the pain of the candle, it's what happens after. A flush tells you where the weak hands are. The rebound tells you whether there's real demand underneath, or whether it was just a mechanical snapback in a thin book. And while silver was getting whipped, gold holding above $5,300 is the macro backdrop refusing to calm down. Reuters explicitly framed this as a market that's weighing war-driven inflation risk and tighter rate expectations, with FedWatch odds of a June hold rising to over 60% in that same report. Reuters. That's why you can't trade this like a sleepy market. The environment itself is volatile, and volatility punishes anyone who's oversized. So here's the final, tracking, not predicting, checklist as we walk away from this update. If silver can reclaim key levels and hold them when the next wave of selling hits, that's when the failed flush starts acting like a base. If it can't, if every bounce gets sold and price keeps making lower highs, that's when this turns into a fake-out environment, where patience beats hero trades. And if we just chop violently in a box, that's the coil scenario. It feels boring and brutal at the same time, and it often ends with the most explosive move of all. If you're trading, remember what we said. A standard COMEX silver futures contract is 5,000 troy ounces, so these swings aren't small. CME Group. If you're investing long-term, Your edge is time and discipline, not being first. Now I want your vote locked in. Comment breakout if you think this flush becomes the launchpad back toward the low 90s and higher, or fake out if you think the next wall rejects it and we see another trap. And if you want me to keep doing fast updates the moment the next violent candle hits, hit like, subscribe, and comment 5-minute update so I know to keep these coming in real time. Final reminder, this is educational and entertainment only, not financial advice. And in the next video, we're going to take the exact 3 proof signals we discussed and score them live, so we're not arguing opinions. We're reading the tape.